They threw everything they possibly could at the market in a very short and extremely aggressive window of time without hesitation. Speed was used deliberately so that people would not have enough time to think or react logically. Fear was injected through sudden, violent red candles designed to shock the viewer emotionally. Volatility was amplified on purpose, to make the entire move feel uncontrollable and chaotic. And still, even after all of that coordinated pressure, the market simply refused to break down. Today, I don't want you to look at silver as just moving lines or colors on a screen. I want you to look at silver as a complex financial system that is currently under visible stress. Because what happened here was not random price movement driven by chance. It was not caused by retail emotion or accidental selling by small traders. And it was definitely not a normal or healthy trading session by any definition. This move followed a very familiar, institutional pattern that has been used many times before. When large players feel pressure, they don't invent new tactics or strategies. They repeat the same playbook that worked during previous stress events and crises. Those strategies are carefully designed around predictable human behavior. They specifically target areas where fear already exists beneath the surface. Obvious support levels on the chart become the first point of attack. Psychological round numbers become the second and more emotional target. Weak, over-leveraged, and impatient positions become the final objective. That is exactly how these engineered moves are constructed step by step. Sudden drops like this usually happen during periods of low market liquidity. They happen when most retail traders are asleep, distracted, or offline. Early today, price moved sharply lower with very clear intention and urgency. It dropped directly from the Asian session highs without any warning. There was no slow build-up and no gradual decline to soften the impact. The market was pushed aggressively toward the low $70 zone. That level was not chosen randomly, emotionally, or by coincidence. This is where the majority of retail stop losses are tightly clustered. This is where leveraged accounts begin to experience real financial pain. This is where margin calls start forcing automatic liquidations. The objective behind this move was extremely simple and very old. Trigger panic selling as quickly as possible before logic can return. Force weak hands to exit their positions at the worst possible prices. Create a fast-moving chain reaction of fear-based decisions. And then allow momentum and algorithms to do the rest of the damage. In a normal and balanced market environment, this strategy works very well. Selling pressure feeds on itself and creates even more selling pressure. Fear compounds rapidly and overwhelms rational decision-making. Price collapses faster than most people can emotionally process. Weak hands exit at the exact. Instead of collapsing further, the selling pressure slowed as buyers stepped in at key levels. Even though volume spiked during the drop, the price refused to continue downward sharply. This high volume without follow-through signals that supply is being absorbed by serious buyers. These are not short-term traders chasing a quick bounce or acting emotionally. These are participants with long-term needs and real obligations. Industrial buyers and strategic players focus on securing supply, not short-term price swings. As price moved back above the session open, the market structure showed strength. The attempted panic flush did not break the system or force weak hands out entirely. This is where paper markets and physical markets behave differently. Paper reacts emotionally and often exaggerates fear. Physical markets act logically based on supply and real demand. Industrial buyers do not pause procurement when red candles appear. They see opportunity during panic moments and step in to accumulate supply. Panic sellers unknowingly provide the liquidity needed for these strategic buyers. That is why the recovery was fast, sharp, and decisive. Price snapped back instead of drifting lower, showing real demand dominance. This was not a speculative bounce driven by hope. It was necessity. Traders focused only on charts saw chaos. Buyers focused on supply saw opportunity. That difference in perspective explains the strength of the move. Physical demand responds to inventory and delivery obligations, not emotion. When physical demand absorbs selling, the market signals that supply is tight. Price is no longer fully controlled by sentiment alone. Stress in the market reveals itself through structure, not just charts. Weak hands exited as intended, providing liquidity to strong hands. Strong hands remained in control, quietly accumulating positions. Fear was tested aggressively, but failed to dominate outcomes. The market communicated that engineered panic cannot break a supply-backed market. Every drop in recovery showed who controls the real market: strong buyers. Observing these dynamics is critical for understanding true market behavior. Panic in the paper market does not equal weakness in the physical market. Today's price action demonstrated that strategic accumulation can counter engineered selling. Red candles alone cannot force long-term buyers out of position. Supply and obligation dictate outcomes more than fear and emotion. The market held because the physical buyers acted decisively. Weak hands were removed. Strong hands gained control. Panic sellers created opportunity for strategic accumulation. The real lesson is that physical demand dominates over paper panic in critical zones. Structural resistance in the market is revealed through price absorption at these levels. The move showed the system's resilience under stress. And the ultimate takeaway is that fear may shake some participants, but strong hands always prevail. After the earlier flush, the market began showing real signs of stabilization, proving that strong hands were firmly in control. Weak participants had been shaken out, leaving the market in the hands of those who understand long-term demand. Buyers with genuine physical needs stepped in steadily, absorbing every ounce of supply offered at key levels. Every small dip became an opportunity for accumulation by strategic participants, further reinforcing market stability. Paper traders, focused only on charts and temporary volatility, might have expected continued collapse, but they were mistaken. The true market was dictated by physical demand, not by emotional reactions to short-term price movements. This difference highlights why temporary volatility does not equal structural weakness. Volatility can create fear, but it cannot erase real-world obligations or physical demand that must be fulfilled. Strategic buyers operate under firm contracts and schedules, which require action regardless of red candles. They prioritize securing material, meeting delivery commitments, and avoiding penalties over short-term sentiment. When price touched critical levels, these buyers stepped in decisively, absorbing selling pressure and ensuring market strength. The speed and consistency of accumulation revealed the depth of demand that casual observers often fail to see. Panic selling from weaker participants provided the liquidity needed for strong hands to strengthen their positions. Real demand remained unshaken, demonstrating the limits of engineered panic attempts. Physical buyers act according to contracts, production needs, and operational necessities, not speculation. The market structure remained intact because strong hands quietly absorbed, selling without hesitation. Each recovery after minor drops reinforced the dominance of real buyers over temporary paper market reactions. Observing these dynamics reveals that perception of chaos can often mask the reality of strategic accumulation. Price absorption at key levels signals structural resilience, proving that temporary panic cannot destabilize a market with obligation-driven demand. Every drop and subsequent recovery reinforced the principle that strong hands dictate outcomes. Price action communicates structural strength more effectively than any headline or news report. Understanding the distinction between short-term volatility and real physical demand is critical. Strategic accumulation, not speculative swings, drives the market direction in these critical moments. Weak hands were removed, but strong hands maintained control and stability. The market's resilience was evident as buyers continued fulfilling their obligations without hesitation. Panic tests failed, and structural strength became apparent to anyone observing carefully. Price is now supported by both real demand and deliberate strategic accumulation. Traders who focus only on temporary fluctuations might misinterpret the market, while those understanding fundamentals see clarity. Physical necessity always dominates over short-term paper panic. Each recovery after the flush reinforced the power of obligation-driven demand. The market demonstrates that engineered fear can shake weak participants, but strong hands ultimately control outcomes. Observing these moves provides insight into who holds real power in the market. Panic may temporarily remove weak participants, but it cannot alter underlying structural demand. Strategic accumulation and operational obligations drive the market's resilience. The attempted panic failed, and buyers remained in control, securing stability and supply. Price is sustained by real-world need rather than speculation. Lessons from these moves emphasize that strong hands always prevail over fear-driven participants. Understanding this principle is essential for anyone serious about market dynamics. The ultimate takeaway is clear. Weak hands provide liquidity, but strong hands dictate outcomes, ensuring market stability. With the previous moves behind us, the market now demonstrates clear signs of strength and resilience, with strong hands firmly in control. Panic attempts have failed, leaving only participants who understand the true dynamics of supply and demand. Buyers with real physical requirements continue to step in, absorbing all available supply without hesitation. Every dip in price has become an opportunity for accumulation by those who operate with long-term goals. The paper market may still show temporary red candles, but the underlying market is dictated by real obligations. This distinction is vital. Temporary volatility does not equal a breakdown of structural demand. Volatility can scare weak participants, but it cannot eliminate actual physical need or contractual obligations. Strategic buyers act decisively because their priorities are securing material, fulfilling deliveries, and avoiding breach penalties. When price reaches critical zones, these buyers absorb all selling pressure, maintaining market stability. The market reaction highlights the depth and seriousness of underlying demand that casual observers often miss. Panic selling provides the liquidity necessary for strong hands to strengthen positions and secure future needs. Real demand cannot be shaken by engineered panic when the buyer's focus is long-term obligations. Physical buyers act based on contracts, operational requirements, and production schedules, not temporary sentiment. Strategic accumulation by these buyers keeps the market strong, even when paper trading shows stress. Every recovery following minor dips reinforces the dominance of real demand over speculative moves. Observing how strong hands absorb selling clarifies the difference between perceived chaos and actual market behavior. Price absorption at key levels signals structural resilience and confirms that temporary panic cannot control a supply-backed market. Weak hands provide liquidity, but strong hands maintain control and determine the true direction. Each drop in recovery illustrates that obligation-driven participants dictate market outcomes. Price action communicates structural strength more effectively than any headline or breaking news. Understanding the difference between short-term volatility and real physical demand is essential. Strategic accumulation, not momentary swings, drives the market's true path. Weak hands exit, but strong hands ensure continuity and stability. The resilience observed in the market today demonstrates the enduring power of real demand over temporary fear. Panic attempts failed because physical buyers maintained focus on procurement, contracts, and operational needs. Price is supported by actual demand, not speculation, which explains the sharp recovery after engineered dips. Observers focused solely on temporary price movements may misinterpret the market's health. Fundamental understanding reveals clarity in the market's long-term trajectory. Necessity-driven purchases outweigh any short-term paper panic or volatility. Every recovery after dips reinforces the strength and control of obligation-driven buyers. Strategic accumulation ensures that strong hands remain in control while weak hands are removed from the system. The market's resilience proves that engineered fear cannot dictate long-term outcomes. Price stability is maintained through active, disciplined accumulation by those with real obligations. Panic may temporarily remove weak participants, but strong hands always prevail. Understanding these dynamics is crucial for anyone serious about markets and supply-backed assets. Each move highlights how strategic participants absorb selling, reinforcing structural strength. Temporary volatility may shake perception, but real demand maintains control. Lessons from these price movements demonstrate that long-term, obligation-driven buyers dictate outcomes. Panic may provide liquidity, but control always rests with those operating with necessity and strategy. The ultimate takeaway: strong hands dictate the market. Weak hands provide liquidity, and physical demand secures stability and resilience for the future.